So what's happening with interest rates in Canada? And how is that affecting the housing market? Well, in this video, we're going to cover off a CBC article, which is going to cover off what's happening with interest rates, especially since the Bank of Canada announcement last week of another rate hike for the overnight rate. And make sure you stay until the end because the article talks about the trigger rate, and the trigger rate is definitely going to affect the housing market. So let's get to it. Hi everybody, my name is Connie Sarvanandan. I'm a real estate agent and investor here in Toronto and the GTA, and I think we should just get straight to the article. Okay, so this is the article. It's from the cbc.ca, and the title of the article is Bank of Canada hikes interest rates to 3.25%, triggering higher payments for more borrowers. And basically what the first few paragraphs here talk about is the fact that last week Bank of Canada raised its overnight rate by another 75 basis points to 3.25%. Now, the last time in Canada that the Bank of Canada had a 3.25% overnight rate was way back in 2008, so over 14 years ago. So it's a 14-year high. And this is after they've had historically low overnight rates over the pandemic. Now, the Bank of Canada's main mandate is to control inflation. So they started raising the overnight rate in order to control inflation. And so the overnight rate doesn't directly set things like mortgage rates and line of credit rates and everything else, but it heavily influences it. And that's what they're saying in all of this. And then they show this great chart, which really explains it quite clearly. So the blue line is Canada's inflation, right? And then the red line is the overnight rate. So what you'll see is Canada's inflation was, 1.75. It hit a high of 3%, probably midway through January 2018. And then it started to come back down. And then in January 2020, which is right around here is when the pandemic started, inflation dropped significantly. And so when inflation dropped significantly, the Bank of Canada overnight rate, which was sitting at 1.75, they dropped it to 0.25% to try and stimulate the economy and other things. And so they kept it there for 2 years, right, during the pandemic, 0.25. So money was very cheap to borrow. And then what you saw with the inflation rate was that it kept low, but then starting in January 2021, it started to rise, and it kept rising, and then it hit a 30-year high of 8.1%. So we all feel this right now. You feel it everywhere you go. So whether it be gas prices, grocery prices, the cost of anything from building materials, everything is more expensive. And that's what this inflation is. And because Bank of Canada's mandate is to keep inflation under control, they started raising their overnight rate to try and bring it under control. So it did come down a little bit, but there's a long way to go. So that's why they're saying that they're still pretty committed to raising these rates. But the problem is that they're raising these rates so fast that it's really affecting new and existing borrowers. So let's look at the next few paragraphs. Okay, so the next few paragraphs really talks about this, which is aggressive series of hikes. So they are quoting Jimmy Jean, who is the chief economist with the Desjardins Group. And what he's saying is basically, look, the Bank of Canada's mandate is to lower inflation. Inflation right now is sitting at 7.6%, and what they think is a reasonable amount is 3% or less. So he's seeing that this aggressive activity is going to continue, and he's saying even, look, 5 hikes within 6 months is aggressive by any stretch of the imagination, but inflation is still out of control. It's at 7.6% today. So until it's under control, they're going to continue this. And he's expecting this to last throughout 2023, and he's expecting it to last even if there's a recession, even if there's insolvencies. He's expecting it to last because Bank of Canada's mandate is to control inflation. So as these rates start to rise, you're going to see a lot more people affected by this, because anybody with a variable rate mortgage is seeing their payments go up and up and up. And so the next few paragraphs talks about the trigger rate. If you're finding value in these videos, please like and subscribe. It really helps us out, and it lets me know what kind of videos are valuable to you. And if you have any real estate needs, feel free to call, text, email, or WhatsApp, and we'll be sure to take care of you. And if you want to talk to me directly, I'll put my calendar link below. And finally, if you have any comments, good or bad, we love hearing them. So please make a comment below. So the next few paragraphs talks about the fact that the trigger rate is imminent for many loans. So what they're talking about is that there are many Canadians that have variable rate mortgages, and many of those mortgages means that they have a fixed payment amount, and that payment amount covers both interest and principal pay down. And so even though your interest rate is varying, it gets adjusted, but your payment stays the same. But the problem is, as the interest rate keeps rising, you're spending more and more on interest and less on the actual principal pay down. So the more interest you pay, the less principal you're paying down, which can extend the loan. And then on top of that, you're going to get to a point where the interest is so expensive, it may not cover off your payment. So they have a great chart that explains all of this that I want to share with you. So this example that they show is somebody who has a $500,000 mortgage at 1.45% for 30 years, which would cost them $1,713 a month. And so they started off that variable rate interest at 1.5%. So in March at 1.5%, the yellow is what they're paying in interest, and then the gray is what they're paying for their principal. So they're paying down their principal amount by this amount. Then as of September 6th, their interest bumped up to 3.7%. So now look how much they're paying in interest versus the principal pay down. So already this shift would have extended the life of their loan because they're paying so little in their principal pay down. Now you're looking at their entire payment going towards interest. So the only thing that the bank can do is increase their total monthly payments. And, they're going to be negotiating with the bank on what that new number is going to look like. So that is the concern for people, is that now this is the trigger rate. When the trigger rate is reached, when the portion paid to cover interest exceeds the total monthly payment. And that's what's happening here. So they are saying that this trigger rate is going to be happening to a lot of people. And the next few paragraphs cover off individuals that are suffering with this trigger rate happening right now. So, like I said, the next few paragraphs give examples of individuals who have actually been affected by this trigger rate, or it's going to affect them very soon. And then they just talk about, how many people is this going to affect? Well, what they're saying is it's hard to tell, but data from the Bank of Canada says about a third of all mortgages are variable rate loans, and within that, 2/3 of them have fixed payments. And then they give this example from the Royal Bank of Canada, which estimated last week that about 80,000 home loans on its books are soon to be hit by their trigger point. Our records indicate you may be approaching your triggering interest rate, a moment when your regular payment is no longer enough to cover the interest rate portion of your mortgage. If this event occurs, your mortgage payment will automatically increase. And what they're saying is that on average, it will increase by $200 a month. And then that's it. So I think that's the gist of the article. So what do I think about all of this? So what do I think about all of this? Well, I have two thoughts. First of all, I think the article itself is a great article if you need a quick reference point for the Bank of Canada overnight rate, the inflation rate, and also understanding the trigger rate. It's just a good article that has some good graphs that easily explain those things. How this is going to affect the market? Well, we're in unprecedented times. Remember, we have not seen the overnight rate at 3.25% since 2008. So we haven't seen that in 14 years. And when we hit this 8.1% inflation rate, we hadn't seen that in 30 years. So yes, now we are seeing a decline in inflation, but we're still at 7.6%. So that's really got a long way to go. So I think what's going to happen over the next 2 months is really going to be telling. Also, this is when those affected by the trigger rate are really going to see it. Now, according to the Bank of Canada's numbers, if a third of the mortgages are variable rate, so let's just say 33%, and then 2/3 of those would be this fixed payment that could be affected by the trigger rate, that's 22%. So let's just say for easy math, 1 in 5, it's really going to be about those individuals and how they budgeted it and what they had planned for, and whether or not that they could handle an increase in their payments. We have the stress test in place, so they should have had a buffer for increases. Whether or not the buffer was going to cover all of these increases is questionable, but there should be some buffer in place. So I really do think what's going to happen over the next few months is really going to be telling. Now, that said, I think this article is really great for any of you who are thinking about buying or selling. From a buyer standpoint, you really need to understand the financials. You need to understand what your mortgage options are and what can happen with those mortgage options when interest rates rises. And then from a seller standpoint, you need to understand what your buyers can potentially pay. Remember, not everybody is going to be affected by interest rates. That's really your buyer pool. So if your buyer pool is somebody who's getting a mortgage, then yes, they will be affected by interest rates, and the higher interest rates will affect their overall budget. But if your buyer pool does not typically get mortgages, then you don't have to worry about this as much. So for example, downsizers are typically mortgage free. They have sold, they've been in their homes for a long time. They've paid off their mortgages, and then they're selling a bigger home and downsizing. So they're just paying cash. They're not affected by this at all. So it really depends on your buyer pool and understanding that. And again, like I always say, the more you know, the better your home buying or selling experience will be. And if you found value in this video, please like and subscribe. And if you have any comments, good or bad, please put them below. We love hearing from you. And finally, if you have any real estate needs in Toronto or the GTA, feel free to call, text, email, or WhatsApp, and we'll be sure to take care of you. And if you want to talk to me directly, I'll put my calendar link below. Thanks for watching, and we'll see you soon.